provisions, criteria. I'm going to talk to you now about the recognition criteria that apply to provisions. There are 3 of them as it goes. But I'm also going to use this recording to talk to you about what a provision is and also tell you why that there is a need for those criteria that we are going to see in just a moment. Let's start with what a provision is. A provision is a liability of uncertain timing or amount. So we definitely have a liability, but we're not sure when the cash will flow or indeed exactly how much will flow. So we know that we must pay this liability, but we don't know how much or when. That's what a provision is. And a provision can be anything that fulfills that definition. As long as you fulfill the definition of a liability of uncertain timing or amount, then you have a provision. But there are certain classic examples that are useful to illustrate what provisions might be, and they're pretty much all bad news. I'm going to give you a short list of 4. Environmental provisions. You are required to provide if you cause environmental damage. If there is pollution on your land, you'd be required to provide. Redundancy provisions. This is the real classic and very grim. Once you give notice to your employees that you are going to fire them off, then you are required to provide for the cost of that redundancy payment. Litigation provisions, again, hardly good news. When you're being sued and you can predict that you probably will lose, but you're not sure exactly how much you're going to have to pay, again, that results in a provision. And here's one that's not really, it's not good, but it's not bad either. Often when you sign a deal with a government to build a building, it's commonplace to agree to pull that building back down again. The classic example is an oil rig. Everyone seems to use an oil rig, and I'll be using an oil rig to illustrate this idea. So you sign a contract with the government to build an oil rig and then pull it back down and make the sea floor safe again. So there you go. There are 4 examples of provisions, but there are criteria for the recognition of provisions, and the criteria came about due to a demand, due to a need for criteria, and it's all to do with creative accounting. Here we go. No criteria results in creative accounting. Now, most creative accounting is related to fairly unsophisticated pushing up of profit. When we're talking about corporate reporting, we're talking about big entities with a separation between directors and shareholders, and the directors are trying to push up the profit in order to make themselves look more able, increase the value of the share-based payment. Generally speaking, with creative accounting, in big corporations, you're talking about pushing profit upwards, and that's all it is. But this one is more sophisticated than that. It's a process known as profit smoothing, where directors seek actually to push profit down in the first instance. Let me show you how it works. So here's a little slide looking at the profit smoothing cycle. I'd like you to imagine, first of all, an entity has a good year, a bit too good, to be honest with you. It seems to indicate volatility. So what they do is they provide. That pulls the profit down to a more expected profit. But then they have a bad year. And because the directors have made a provision in previous years, they are able to release that provision into the P&L report and push the profit back up again. And it is literally cyclical. It goes round in a circle. So there's a good year and the entity then provides, and then there's a bad year and then they release, and there's a good year and they provide, and there's a bad year and they release. And the effect of this is very profound. I've got a couple of graphs here to illustrate what I'm talking about. Here is what the business is really like, the underlying business. It's quite volatile. As you can see, it's a flat line, but it's volatile around that flat line. And that is the true nature of the business. But if you do profit smoothing, this is the effect. And what you're saying to your shareholders, if you tell this story, is that actually the entity is in fact safe and stable, whereas actually the truth is that it's a risky business. For me, it's one of the most cynical forms of creative accounting you can do, because you're attracting shareholders who are risk averse to your risky entity. It's really, really cynical. So, I'll just do the graphs again. So the graphs are actually very volatile, and what happens is we push down the peaks and we pull up the troughs. We push down the peaks and we pull up the troughs. And the effect of doing that is to give not a flat line for profit, but a profit that's roughly flat around the median. And you can see what the story is there. It makes the business look like it's stable when it isn't. Now, this works for a number of years, but eventually the business hits a brick wall. It has a really deep trough, and because of the really deep trough, it is unable to release sufficient provision into the P&L. That really deep trough ends up still being quite a deep trough. The shareholders start asking questions. I thought the business was stable. And then they start to find out there's been creative accounting using provisions. And that was the demand that led to this, the criteria. So here are the 3 criteria. The 3 criteria are, first of all, reliable estimate. It must be possible to come up with a reliable estimate of the amount of cash that's going to flow out in the future. Now, the IFRS makes it clear that all this really means is you just have to be able to guess at the outflow. It doesn't really need to be actually dead accurate, it just needs to be any old guess. Then there needs to be an obligation. An obligation can either be legal or constructive. Legal obligation, I think, is quite obvious. It's what we owe because the law says so, or it's what we owe because a contract says so. But a constructive obligation is more subtle. A constructive obligation comes about because of what you've said you're going to do. When you say you're going to do something, that creates a constructive obligation. And you can have either. You can have both, but you can have either. And the last one is transfer. A transfer means a probable outflow. So there must be a reliable estimate, an obligation, and transfer. A reliable estimate, an obligation, and transfer. Or, as I prefer to know it, spot the rot. If you spot the rot, you provide for the rot. If not, not. And those are the 3 criteria for the recognition of a provision. Your job is to understand the provisions criteria.